What we're going to talk about today are the different types of money. There are dollars in investment vehicles that we can put money into for the short term. There's investment vehicles and buckets of money that we can put money towards for the long term. And there's buckets that will fit in the middle that typically will be categorized as midterm buckets of money. So when you think about a short term bucket of money, what we're talking about are CDs, treasuries, checking accounts, savings accounts. Historically, these accounts are not going to provide you with a tremendous amount of tax benefits or a tremendous amount of growth. Over the last 20 years, if we took into account the taxes that would have to be paid, the average return on the treasuries was under 1%. So we don't know what the future holds, but what we do know in the last 20 years, it has not been historically a good place to get a big rate of return, nor big tax benefits. When you look at long-term buckets of money, think of your 401k or your Roth or your stock portfolio or even real estate. All of these different accounts have varying tax benefits. It is either going to be taxed at a capital gain rate. The taxes could be tax deferred inside of a 401k or an IRA, or they could be tax deferred and a tax-free distribution inside of a Roth. Real estate has a whole slew of other tax benefits that we can take advantage of. But in all of these accounts, over the short term, the growth is very unpredictable. You don't purchase a home with the intention of selling it within a day or two for a profit. Although that's possible, it's unlikely. You don't invest money into a stock or into a managed investment portfolio and hope to sell the next day or the next week with a massive return. But what we do know and what holds to be true is that in the long haul, investment portfolios and managed investment portfolios, including real estate, will appreciate in value. In order for us to be able to take on volatility, to maximize the growth and maximize the tax benefits within long-term accounts, we need to have something else to fall back on. Midterm accounts, such as cash value insurances, specifically whole life insurance, is something that can fit in the middle between short-term and long-term. Historically, policies have averaged a 4 to 5% tax-free rate of return, and these accounts provide liquidity. You have access well before you have to wait for your retirement accounts to provide you with penalty-free access. In addition to that, there's tax benefits that are provided to it. The taxes inside of the cash value and life insurance are tax deferred, and there's ways that you can take those dollars out on a tax-free basis.